Now that we have a solid understanding of market trends, the phases of the markets, chalks, reversals, let's dig into identifying pullbacks, because a lot of what we've been talking about has been predicated on the fact that we need higher lows, lower highs to form in the market, which would be our pullback phase. We've talked about the pullback phase, but let's get a little bit more specific. So in theory, any move in the market that goes against the trend or goes against the direction of the impulsive phase can be considered a pullback, as we've discussed. The problem with this approach is that not all market moves are the same. Some counter trend moves are simply pauses in the markets and shouldn't be considered pullbacks. Adding rules to quantify a pullback helps us ensure that each pullback mapped forming market structure is consistently approached. There are three things to look for when determining whether a move is a pullback or not. The pullback is 2 or more candles, not including the candle that created that market swing point. The pullback interacts with a supply or demand zone, depending on if we are bearish or bullish, and the pullback sweeps liquidity. The best way to approach a pullback is to simply ask yourself the question, is there a purpose behind this pullback, or is the market pausing due to low volume or just the overall time of day? After implementing these rules to identify pullbacks, it will become clear that many pullbacks that you see in the market are fake and give a reason for a true pullback to have been initiated. So let's talk about the two different types of pullbacks we're likely to see in the market: a single push pullback and a multi-candle push pullback. A single push pullback is a counter trend move formed by a single push of candles. A single push usually just means that the market is moving strongly in the direction of the trend and there is no need for a incredibly large pullback. So in essence, if we are looking at an impulsive move to the upside, so we're in a bullish trend, a single push pullback would just be a series of bearish candles, essentially all bearish candles in one solid push, and then price would move to the upside. There can be a bullish candle in the middle, but the idea or conceptually is that price is just moving, pulls back in one fluid motion, and then continues moving to the downside. And when it comes to a bearish example, it would be the exact same, except we'd be moving to the upside sharply and then moving back down. A multi-candle pullback is made up of multiple pushes and bigger groups of candles. Often these pullbacks give the impression that smaller pullbacks are forming. Multiple candle pullbacks often generate liquidity and can imply a stacking of orders. Given that a multi-candle pullback essentially creates internal structure, there are many different variations of this type of pullback, which can make it much more difficult to understand. And if we look at this example, we can see that we start to create a bit of internal structure. We create a higher high or higher low. Broken to the downside, we create a lower low, and then price moves to the upside. Now, if we start to identify these pullback criteria, we can get a better sense that this is just the market building that internal structure, generating liquidity, stacking of orders is happening here, but it is a pullback that is happening. Now let's focus on pullbacks with a purpose. And this goes back to the question, is there a purpose behind this pullback? Market pullbacks should have a purpose. This is the reason why the market's pulling back in the first place. Identifying pullbacks that have a purpose other than moving counter trend will provide stronger points of structure to work with. These stronger points of structure will help reduce the fake outs that we can see in the markets. So let's talk about pullbacks forming to interact with supply or demand levels. One of the strongest ways to identify a pullback is for the pullback to be initiated to interact with a supply or demand level. This provides further context on why the pullback is actually happening in the first place. So in a bull trend, the market will pull back to interact with levels of demand, and in a bear trend, the market will pull back to interact with levels of supply. And we have two different variations, as we talked about the single push and the multi-candle push. Here we have a bullish market. We have a single push pullback, taps into the demand level, and then continues moving on into a new impulsive phase, takes out the previous continuation high of the bullish structural range, and continues to print a higher high. Conversely, we have the bearish trend where we put in a lower low. We start to initiate that pullback phase, single push. It's all just one push into the level of supply. Price forms its lower high, takes out the continuation low of the bearish structural range, and continues to print a new market lower low, continuing the bearish trend. Now, if we look at multi-candle pullbacks, we can see that in the same example, we have a bullish structural range. We're creating higher highs and higher lows. We have a demand zone, and price is creating a multi-candle pullback where we get ebbs and flows into that demand level. It looks very similar, but what we can see is there are more clearly distinct levels of structure. So if we look at the internal structure, we see a low print, we see a new lower low print, a new lower low, and then we break the previous lower high and continue up. All of this is encapsulated within the bullish structural range, and we have a pullback with a purpose. We just have a multi-candle pullback. And conversely, if we have the bearish example, we have the market creating lower lows and lower highs. We have our bearish structural range, and with a pullback phase is initiated, we see price coming into a supply level, and internally the market structure is creating higher highs and higher lows. We tap into supply, we exit that pullback phase, we break the continuation point low of the bearish structural range and continue to print a lower low and continue the bearish trend. Now that we've discussed pullbacks with a purpose where we form a pullback to interact with supply and demand, it's important to discuss pullbacks forming to sweep liquidity. Now, of course, we haven't discussed supply and demand or liquidity concepts in depth just yet, so a lot of this might seem a little bit confusing, and you might need to revisit this lesson to really ingrain what's being communicated here, but it's good to set the tone as we continue with the market structure content. So we will discuss supply and demand and liquidity in depth in future lessons, but it's good to bring these points into fruition now and build upon it. So let's talk about pullbacks that form to sweep liquidity. The pullback being started in order to sweep liquidity in the market is another important factor in identifying a pullback. This provides further context for why the pullback is happening in the first place. A sweep of structural liquidity, a reactionary sweep, or a subtle sweep would be considered valid to justify a pullback. Often, multi-candle pullbacks generate sweep liquidity as well. And this is why this market structure gets a little bit confusing and why multi-candle pullbacks were mentioned, that they generate liquidity and can also imply a stacking of orders, which ties in the supply and demand portion. And this is why multi-candle pullbacks can be considered much more confusing when we consider them compared to single push candle pullbacks. Being able to justify pullbacks in a consistent manner helps avoid being faked out in the market. If no rules existed and all counter trend moves were considered pullbacks, many of these pullbacks would be used as liquidity, which provide false market structure signals and ultimately put you on the wrong side of the market more often than not. Now, I'm not going to go into too much depth on these particular situations of pullbacks forming to sweep liquidity, because in order for them to be fully understood, we would need to discuss liquidity concepts, and we'll be doing that in a future episode. But what we can look at very quickly is just the fact that we have structural liquidity sweeps forming pullbacks. We have supply and demand zone reactions creating liquidity sweeps that form our pullbacks. We have multi-candle structural liquidity sweeps. That's being basically multi-candle pullbacks that are creating liquidity that is being swept. So another play on the structural liquidity. And then multi-candle structural liquidity sweeps in just a slightly different flavor. But again, like I said, we'll discuss liquidity in detail in a future lesson. But this is identifying pullbacks, the importance of identifying pullbacks using a rule-based approach so that you have something repeatable, so that you know a counter trend movement in the market is truly a pullback, or it could just be a pause in the market. But by being able to apply these rules to the charts will help us ensure that we are focusing on the true pullbacks and not getting caught up in any of the fake outs. That way, we're always in the know of our market structural ranges and understanding the market structure direction and building our trades on the right side of the market.